right. Happy Friday.
Hey
How you doing?
yo! I'm
Is that
super excited.
super excited for
I'm
today's
just
topic episode or just for Friday?
this is an easy topic for me to talk about, but yeah, I'm ready for it to be the weekend, man. I'm going to blow up the paddle boards and fish and I don't know, do whatever.
Oh, very cool. Are you guys got paddle boards? I mean, I live
Yeah.
right next to the beach and have yet to get a paddle board yet. And I don't even know where to begin with that other than Craigslist or something. It's like I don't want to deal with Craigslist. I mean, I
I
can't
went
even sell
on
these cameras because it's like I've had like 10 people hit me up for one of my old cameras and I haven't even responded because I'm like, I don't know, is it worth it to go meet a stranger for a couple $100? I don't
I'm in that same boat. So, I think I told you like I switched to Olympus, like I wanted to
know.
go mirrorless, and I love this thing, man. I actually wish I would have got when upgrade. This is the EM5. I wish I would have got the EM1 because that's like their, the one step below the pro level. But I'm selling all my Nikon stuff, and same thing. People were like, oh, whatever, and I have like all the Gucci stuff, right? People were wanting to. Will you take $400 for like a
No,
lens that cost me
$4,000.
2,800?
Yeah.
Yeah, I paid $2,800 for this thing when it was brand new, and it's still pretty much in brand new condition. No, I
Mhm.
will not take $400 for it. So,
Like, I don't need to get rid of it that bad. I mean, that's kinda where I was at. I was like, "Well, I don't know, maybe I would get back into photography again." And it's funny, I just got off a call, with, John Renaker from, who's got a travel, uh, business and helps people, uh, you know, save a ton of money and do really cool travel trips, and it just, brought me back to all my photography and kind of what being self-employed um and following this strategy, basically what we're identifying as the war chest method or war chest strategy. I'm still throwing that word around to figure out what we want to call it, but I think we're going to stick with strategy. But the freedom it gives you to do things like travel if that's your thing. But I gotta think that anybody should be traveling and seeing the world, even if, but not to just take selfies. If you are going to do photography, take a shot of the place, but otherwise experience it, because I think everybody's getting sick of these selfies, right?
Yeah, well, that's they talked about that, like those types of cameras that we're talking about. People say, "Oh, those are going away," that because phones. I'm like, phones are for what a lot of people do. Phones are fine, but I
Mhm.
think like for people like you and me who enjoy, like for me, it's more about getting out there. And because I'll tell you, like when I was in the Navy, we used to go out to all these places out west, and I loved it. Every time I would go out, I would take a week of leave when I was done and go to Yellowstone and Grand Teton and Zion National, like all those places. I used to go there. I bring all my camera stuff with me and spend a week out there. And for me, like I got a lot of good pictures and stuff, but really, it was just more about being out there and seeing things. And
Mhm.
you know,
Did you
I
try
know
to pet a
the
pet a buffalo, but like most Americans do?
no, I saw tons of them. I've got some really good ones. I'll show you. I found some buffaloes, bison, whatever you want to call them, buffalo fighting, and I got some awesome pictures of that. They were like, I don't know, a couple hundred yards away, and I had a big zoom lens. I had like a 500 millimeter zoom lens,
Mhm.
and because I had all that single guy E7 money, and so I was just buying all kinds of. But anyways, this one he's all rowdy after the fight, and he just runs all the way towards the road where I'm at, and he's literally across the road from me, and he just starts romping around and goes up to this like 10-foot tall pine tree and hooks it with his head and ripped the damn thing out of the ground, like roots and all. And I was just like, holy crap.
Whoa. All
Yeah,
right.
it gives you an idea how powerful those things are.
Well, speaking of powerful buffaloes and powerful entities fighting, and people with too much money trying to delve into it, I think that's a good catalyst to talk about. what happens in the life insurance industry, and conversations about what is the right thing to do, and who's good and who's bad. And there's a whole lot of this online if you do any googling on this, or if you talk to whatever expert in, or whatever self-declared expert.
Yeah.
Yeah.
Well,
Someone who happens to know a little bit more information than you at the time, and so
I
it's
don't
really not that
consider any
far.
of them experts.
Right. Nor do we consider, we said it before. It's like, it's not about being an expert. It's about sharing knowledge, getting certifications and licenses and all that really, isn't, there's a lot of very, very intelligent and useful people putting out their information financially online. It's just often in this space, people stop. They find something, and they just go, down one lane. And so that's why we say, hey, the war chest strategy is not for everybody, and it is based on an insurance strategy. And so it's important to know this stuff, but that's what we bring to the table, because we happen to know how to do it, better than most, and we have access, and we're forward looking. We're just looking for more information and new ideas and stuff. And it can complement other things going on. We think a lot of times it ends up being a really good replacement because of the flexibility that it has to it. But I'm not going to try to be a claim to be any sort of financial analyst expert. Like when somebody says, I don't know, I was thinking about getting these stocks, what do you think? It's just like, I think it's a gamble. How about that? That there's my expertise. We have no idea. Nobody has any idea. It's impossible to be an expert in any sort of investment space, because we don't know the variables. And so anytime somebody says, oh, we've got this real estate thing going on, we're looking for investors, we're guaranteeing 11% rate of return over 2 years, and it's like, here's the one thing you don't say. That's if the deal works out. There's an assumption that it's going to work out, and the real estate market's always gonna keep going up, or whatever it is, or we're going to be renters. For people doing commercial real estate deals, who saw COVID come in, and now next thing you know, people are working at home. So that's why it's important. We get into this topic. This happens to be the one we focus the most on, but I know today is kind of still just a broad brush for introducing people to this stuff. So we're not going to talk high level strategy today, I don't think, but we are going to hit wave tops on what it is when these topics come up. What do you actually need to know versus just saying, oh, this is the first thing somebody told me. I need life insurance because I might die one day. And again, we say, no shit. That's the only thing. That's the only here. I'm an expert at that. You're going to die one day. Like, that's not helpful. That's not an efficient way to leverage something as powerful as insurance. I mean, it is the most powerful financial asset out there, because it's based on an individual. The one thing that you actually do have control of is you and your life. And so that's why I find it to be so powerful, and all the things we talk about. But
Yeah.
yeah, man.
So I think
What?
to hit on that, like it's funny, we were just talking about photography and stuff, right?
Mhm.
Um, I think a lot of people look at this through a very narrow aperture, right? The very small, tiny little hole. And, because that's most of the time when I go talk to somebody who's like, oh, I want to look at investments and stuff. They don't know what they're talking about. They don't understand asset classes and asset types. They come to that same question: what stock should I buy? And my answer to that is none. You, as an individual, a person just starting out investing, don't buy stocks, because you're not going to win in that game. Look at all that stuff that happened with Robinhood a while ago, right? Oh
Yeah.
man.
Well, I mean,
Um,
it's like when the first thing everybody should do is the Roth IRA. Like, it is this cookie cutter thing that everybody needs to do, and it's like, no, that's too simple. That's not helpful. I mean, it's an incentive to get people to put money somewhere, but can we do better? Can we, there's a reason why most people end up not doing it, because it's not interesting, it's not motivating. Where's the opportunity in it? It's like, oh, okay, well, I was told if I put my money here and wait for 40 years, it'll double or triple or quadruple. Maybe, but chances are all sorts of things are going to change in your life between now and then, and and we want to be more strategic with it.
I think doing that by itself, yeah, absolutely. It's dumb to just do that one thing by itself.
Hmm.
And I mean, my personal, I have a multi-prong approach. Like I use permanent life insurance. I do real estate, and I have retirement accounts too.
Yeah.
Um, but really the two that I put the most effort towards are the real estate and the permanent life insurance, because that actually we'll talk about it as we go down, like when we get to like how do you use it. That's something that a lot of real estate investors do, is use permanent life insurance as their act as their own banker. But I guess really, probably be good to start talking about like, hey, what exactly is permanent life insurance?
Hmm.
And I don't care what the gurus say, the people that they're not experts, they don't work in the industry, they may know some things, they may go in, pick out some things that they don't like, and just say this is why this is a bad thing. And that's just, they're just squawking. But essentially, permanent life insurance, we talked about the term in the group and stuff. Permanent life insurance, you're paying more premium for less death benefit, but you're also building equity inside that account. And the good thing about that is, when I say equity, there's a cash value component to the account. Um, and it acts a lot like kind of a Roth account, right? Because you're putting after tax dollars in, the growth isn't taxed. Um, Big difference is, depending on which one you go with. I'll talk about the different types here in a few minutes, but that cash isn't tied to the market. So, if you had a Roth IRA, I'll bet you last year you probably watched it take about a 30% dip around end of March, beginning of April last year, and you were probably like, oh, that's not good, right?
Right.
These types of policies, that doesn't happen. They just say, oh, okay, well, sucks to be somebody who's completely into the market with all of their assets, right? And
Hmm.
then the other big thing about that is, on the back end, when you take the money out, it has non-taxable withdrawals. And essentially what you're doing is you're taking it out as a loan that you don't ever have to pay back. So those are kind of like the four, the what I view as like the four big things associated with those. The types, really, there's four main types. You have your whole life. The way that works, you pay your money into it, and every year it grows. The growth is normally dependent on a dividend that's declared by the company. So you're going to have a bunch of old dudes sitting there at the end of the year looking at like how the investments have done, what their expenses were, what their mortality experience was. Mortality experience is how good of a job did they do it projecting how much death benefit they had to pay for that year,
Gotcha.
right? So they're going to look at those and they're going to say, hey, based off of all this stuff, we're going to say that we'll declare a 5 or 6% dividend this year, which isn't bad, especially if everything else had a down year. Maybe they say, hey, well, okay, we're still going to declare 6% dividend this year, which isn't, again, not terrible. But the big problem with that is, what if you had like a 15%, growth year and an index or something like that? If the market did, 12 or 15%, you're still only getting, 4 or 5%. So,
Mhm.
it's great from a downside perspective, but I think the opportunity cost there is you're not getting to take full advantage of the upside. So that's
Right.
what they do. They say, hey, we're going to declare this much for the year, and your account will grow by, whatever the cash value is times whatever percentage they declare. Like that's what you're going to get for the year. And then you have variable. I'm not a big fan of variable. I think a lot of people are not fans of variable now, and it's, as far as I know, like I haven't seen a lot of the companies that you and I work with. I don't really see a whole lot of stuff on
But
variable policies.
yeah, it used to be the main thing coming out of the 90s because the story was, hey, the stock market's doing great. Put your money in the stock market and just during the tech bubble, you can get all these great returns, but now there's taxes on it. What if you could do it inside of a tax shelter? And it backfired because when there were corrections, the tech bubble, the 2008 bubble, all of a sudden those people had put money into the variable policies. Now, just like with through a savings plan or a Roth IRA, when you have that 30% decline, that's uh, something you could be concerned about. But more specifically, inside of the universal chassis, you're still paying for the cost of insurance, but now you're 10 years older. And so the cost of insurance always is going to go up. But if there's been a decrease in the amount of assets inside the policy, now you're paying for more insurance at a higher cost, and it can actually eat away at itself. So it can be dangerous in that regard. And that was something that was not considered. It was kind of like real estate when they started selling these things. It's like, oh, it always goes up. I mean, it's felt like people thought the stock market always goes up. There'll be some corrections, but just ride it out, Mr. Client. But it's not. That's not how people react.
Yeah. And so I don't really talk about those very much. I just because it is directly tied to the market, and it kind of takes away like the whole what
And you
I
got to
view
manage
as
it too. I mean, that's
yeah,
the other thing is you got to look into the actual policy and see what I have a variable policy. I actually do, and that's because I bought it back when that was the only one available, or it seemed like it was. And so once I hit the 10 years, I'm going to convert it and
yeah,
move it over to an index. Um, but that said, because I had a variable, I got some pretty good returns over these last 10 years because the market's gone straight up. Uh, but I gotta manage it, and managing it's not like you just log in and change your account. You got to send in a form with all your changes. So there's a lot to think about there for people who have old variable policies, because a lot of people got sold this. They should know, just like with a whole life, if you have a whole life policy, you can convert it to the modern stuff without a taxable event. It's called a 1035 exchange. Just look on our website. If you look at the resources part of our website, where we have the whole section on military and veteran life insurance, I've got some articles there specifically about doing, upgrading the insurance that you already got without any additional costs. It's pretty cool.
yeah.
Or
And
taxes. That's the main thing.
like I was saying, like the variable one that to me takes away what I think is the most important part of this is the fact that it acts as a hedge against the market. So if you have other stuff like that, like 401ks, IRAs, that's kind of like your your buffer or whatever you want to call it. And then you have universal. That's another one. That's the one that I think you and I tend to like the most. Um, there's different types of universal policies too. You have your fixed, you have variable universal too, which again that's tied to the market, which I don't particularly like. The fixed, typically that's like they're going to find something that does, where they can guarantee a 3 or 4% every year. Not a fan of that too, because again, that's the whole point of this is you want to be able to take advantage of the upside when it's there. And so the one that you and I think like the most, and I'll be honest with you, when I first started off in the industry, everybody that I talked to was always all about whole life, and I was always interested in this one, and it's Index Universal Life, the IUL. So I would always ask questions about this, like, "Hey, what about this? This thing looks cool. I don't really know a lot about it." And they would just say, "Oh, no, no, you don't want that. It's bad." And I was like,
Hmm.
"Well, what makes it bad?" And they start going into all the reasons, and I'll talk about them here, like why people say it's not good, and why, like, I came to realize, well, okay, what I think happened is people just don't understand how these things work, and they got too comfortable selling whole life, because that's what I used to do, whole life, and I used to think it was the greatest thing since sliced bread. And then coming over and working with you and Mike, I kind of realized, I was like, oh wow, there's I think I don't think I was intentionally misled, but I think the people that I was kind of learning from in the industry didn't really know about these either. Either that, or they'd say, well, I just don't like it. I think it's too much work.
Yeah, and that's the thing. It's work. It's work to learn something new. Once you're if you make it past that 95% failure rate in this industry and you figured out a way, all right, I figured out a way to get clients, talk to them about the portfolios, do some rollovers, sell them some insurance. I've already got my story laid down, then they stick to it. And that's why there's no innovation in this industry. And frankly, that's why so many clients are end up being unhappy. And really most of this industry is just people moving from one advisor to the other because there is no control to take over it. And that's when I realized, why the index, how the index universal life thing works. I couldn't believe nobody was talking about it, and I realized, oh, they just feel uncomfortable, being part of the new thing. It's just like they feel uncomfortable blogging or doing a video or doing a podcast. That's not me. That's not me. I'm not that. And so, but how are you serving the people if you're not finding the most up to date information? So I found that
Yeah.
to be quite telling. The reason why there's a lot of unhappiness in our industry, both from the professional standpoint and the individual client.
Yeah, and then there's a fourth thing. I'll just touch on it. I won't really dive into this a lot because I don't think it applies to the majority of the population. There's what's called a MEC. It's a modified endowment contract. So one of the things that people who already have tens of millions of dollars learn is that they want to one of the big things that they want to do is shield whatever they have from taxes and loss, right?
Hmm.
That's I go back to this. That's why I'm so big on the protect or hedging against market downturns. There's a book that I read a long time ago where the one thing that I really remembered from that book was there's more to be gained by avoiding losses than there is by picking winners.
Right.
And that really stuck to me because you know me, I nerd out. You've seen my spreadsheet with all the calculators and comparisons that I've built out and show to people. Like, yeah, it's true. When you don't have to worry about negative returns, you are so much better off in the long run. And so, a MEC is it's kind of like a life insurance contract. Well, it is a life insurance contract.
Hmm.
It's provided by a life insurance company, except that any distributions you take from it are taxable, and you get taxed on the growth. Basically, it's a estate planning tool to pass whatever assets are left in the account on to your family. Um, you know, with a little bit of tax strategy built into it. But if you don't have tens of millions of dollars, not a big deal, right?
Right.
So I like to bring that up. Not really relevant to a lot of people that are probably listening to this, but it's out there.
I think the
It's
main thing to know is that inherent in the policy design, they prevent these things from becoming a mech,
mhm.
so that there's not a taxable event, and so it's kind of built into it.
Yeah, and that's like a planning parameter that we use. How do we make sure that you don't fall into that trap?
Mhm.
So, I think that probably the next big thing to discuss with these is, well, how do you use them? Right. And there's different ways. I mean, there's tons of different ways you could use it, but I'm trying to limit the, to five kind of main areas. The war chest one, which you and I were talking about, we had some focus groups talking about that. I like that idea. Um, that's a great way to use this before your retirement, right? Because excuse me, you've got a lot of time in between now and when you retire. Dude, I'm at least 25, if not 30 years from retirement,
Mhm.
right? I want to be able to have access to this stuff if I want it right now. So um, that's kind of like hey, I have this money in here, I can use it. And this is kind of this is a strategy that a lot of real estate investors use. They'll have a permanent life insurance policy where they keep their cash, and if something pops up, they say, hey, I want this property, whatever. Guess what? I don't have to go get a loan from a bank or somebody like that to get this. I already have money inside this policy. I can use that to secure it. And after I've done that, because it's a lot easier to refinance something than it is to get, initial financing for it. You can refinance it, take the money, put it back in there, go on and find your else. What do they call it's like you're like acting as your own bank, right? What do they call
Yeah.
that? The
Infinite banking, bank on
yeah.
yourself. It's different
Yeah.
ways. Yeah.
So that's one way that's really popular, especially with people that do real estate investing. Income streams, while you're retired, you can set these things up to provide an income stream. The good thing about these is that you can design the policy to produce an income stream that's also increasing too, because one of the big things that I hate seeing on all these calculators, especially if you go on the guru websites, their calculator says, how much, money do you want for the rest of your life? You put in $50,000 a year and they say, well, you need this much. Well, one of the things that they don't take into account is inflation,
Mm-hmm.
right? Like $50,000 today is worth about, what is it? Like 36,000 20 years from now because of inflation just eroding away. So that's kind of when I see that stuff, I'm like, that's garbage. Stay, somebody says, oh, I just need $50,000 a year for the rest of my life. No, you don't, because in 20 years from now, you're going to need $75,000 a year for the
Mm-hmm.
rest, and then 20 years after that, it's going to continue to go up and up and up. So, one of the things about these that I like, especially with the IUL, because you can take advantage of the upside, is that you can provide that income stream that's going to increase every year. And, you'll still have a lot of times, you can plan it for, out to various ages. How long do you think you're going to live? You can be conservative with it. And, the other big thing about this too is it's tax free. Like,
Mm-hmm.
so it's not going to affect the amount of taxes that you might have to pay on your Social Security income. Any other assets that you have, it won't add on to that tax burden, because a lot of people don't know this. If you're taking money out of especially like a traditional IRA or 401k, that's taxable income to you. That could affect the tax status of your Social Security.
Mm-hmm. So yeah,
Um,
especially if you're getting a military pension, that's fixed
yeah,
income. Anything coming out of a traditional retirement account is fixed income. And the only asset class, and then within the life insurance is the only asset class, and within that asset class, an IUL is the only product that can guarantee an inflation hedge on a stream of income where you don't have to worry about taxes. And so it's pretty powerful. It's very powerful addition to anything else you might have going on for saving for the future. And it takes a lot of the unknowns and the gambling off the table, throwing it at the stock market, managing portfolios, and having to pay someone to do it. It's like it's all built into the system. So we call it, it's a war chest. You just throw it in there, let it do its thing, and hey, when you need it, you pull it out, and it'll keep growing with you.
yeah, and yeah, I'll talk about like how that works here soon. Um, the next one, this is kind of my own personal favorite way to use it, but I try to go over everything with people and let them figure out how do you want to use it. But this is the one that makes the most sense to me. Is I like using it as kind of like a buffer type strategy, right? So if you look, I think the average length of retirement right now is probably around 25 years. And if you go back and look through the history of the market, you could probably expect there to be anywhere from 5 to 7 down years in the
Mm-hmm.
market. And so the big thing that you don't want to happen is anything that's, IRAs, 401ks, brokerage accounts, whatever. You you don't really want to take money out of those when the market's down, because that's like the old saying, like you don't lose until you sell while you're down. That's what happens. If your shares are worth $100 each and the value of that drops down to 75 shares and or $75 a share, to get that same amount of money you would have needed before, now you have to sell a lot more shares. So you're never going to come back. Well, it'll take a lot longer to come back to where you were before. Your money has to work that much harder. So, with the buffer strategy, you can say, hey, okay, my Roth IRA, my, 401k, whatever is down right now, 20 or 30%. I'm going to take money out of my IUL, which didn't lose any value, and, just to hold me over until this stuff recovers. And, once I get back to where I am again, then I can rely on those. So to me, I like that. There's a lot of actuary math that's been done over the years on like how much you can take out confidently with a certain percentage of chance of success, right? We've all heard that, like the 4% rule, too, right? I think they say like if you withdraw no more than 4% of your assets at any given time, there's like a 90% chance that you'll never run out of money. Well, when you include a buffer into that strategy, that math actually goes up. You can actually take bigger withdrawals. You can take what is it, like 7 to 8%
Right.
confidently.
It's like what's the point of saving all this money if you're just limited or too afraid to actually use it?
Yeah.
If you can add the buffer and actually access more of it for a longer period of time, isn't that the point?
Yeah. It gives you, more security, and you get to, use more of your money for things that you want to do. You don't have to pinch pennies in retirement and take care of you and your cats.
Right.
Right. So we were talking about that, right? The IUL, how does that work? Well, basically, and this is how all permanent insurance policies work. You pay your premiums into this thing, and they take that money, they go out and insurance companies are financial institutions. A lot of people don't really understand that. And that's why a lot of people that work in financial services, most of them start at, insurance companies. But basically, they take your money, they go out, they do their investing. They are extremely sophisticated investors. They do stuff that you or I could never do. But basically, what they do is at the end of that year, they say, "Hey, thanks for letting us use your money. Here's, we're going to credit your account now with however much, like we talked about that with the whole life. They're going to declare, 5 or 6%, whatever." With the IUL, what they do is they look at indexes. They follow a market index, so your money's not actually tied to that index. They look at whatever index you've chosen for that account, and they're going to say, hey, based off of all these parameters that we did in the design, we're going to credit your account this year with, a percentage of whatever that index did. You'll probably look at, 90% of whatever the market did, uh, you know, depending on, there's so many variables. I can't sit here and say any, in a general term, like what it would look like, but that's like you were saying, like the more specific things, you have to do that individually. So the good thing about that is because it's not directly tied to the market, if that index goes negative for the year, no big deal. You just don't make anything in that year, right? They call it the index crediting strategy. And, I've gone out and looked at the math. I look at the returns over the years and compare it to something that's tied in the market and can go down in value. And there's no comparison, right? It absolutely, can't beat the index crediting. And I just, there's probably some whiz bang options trader out there who maybe could beat that. But for the average everyday person who doesn't sit there on their computer and look at tickers all day, like, it's not, you're not going to be that person that beats the market. So, but that, because I've had a lot of people ask me, like, how does this thing grow? That's essentially what it is. It's the index crediting strategy. So, and that's what enables it to take advantage of more of the upside than like a whole life where you're only going to get 5 or 6%. So, going back to the, how do you use it? There's a lot of other different benefits that come along with this too. One of which that we talk a lot about because it's becoming something that's more and more prevalent with the elderly population is long-term care. Some of these policies, some of these, it's a rider that you have to pay for. I've looked at it with certain policies. How much it costs will depend on what kind of rating you get. But typically, long-term care, it'll provide a certain level of income every month, based off of whatever you design in the policy. But for example, like if you had a $500,000 death benefit, right, for purposes of long-term care, essentially what that would do would be it would provide you like $10,000 a month for up to 2 years to cover long-term care costs, right? So it's something you have to pay for. I think I think I just did one not too long ago for somebody who was 40 years old, and it's like $200 a year. But later on down the road, if they end up in a nursing home or something, they're going to get $10,000 a month to take care of that, so their kids aren't having to cover the costs of that, or they don't end up in like a Medicare facility where, uh, probably not the best conditions.
Right. And that
And
depends on the carrier. Everybody's
yeah,
got designed different. Sometimes it's built in, sometimes there's an extra cost and a choice and that kind of thing.
yeah, I was going to say some of them have just a provision inside the policy. You don't have to pay for it. They just say, hey, here's the option. You can do this if you want. But here's what it would look like. And different companies do things different ways, so that's something I always look at is like, hey, is that something that you want to look at? Because if it is, let's go look at these guys instead of these guys, because they have better long-term care stuff in their contracts. And then another big one too, accelerated death benefit. That's a huge one for these types of policies, because if you become chronically or terminally ill, you can actually use some of that death benefit to cover costs that you incur for medical treatments.
Mm-hmm.
There's some stuff too. You have to be certified by doctors for the chronically one. Like you can't do 2 of 6 of the daily activities of living. If you're terminal, then you have to get a diagnosis from a doctor that says, hey, we expect this person to die within 2 years. But you can use some of that death benefit ahead of time to take care of any of those medical costs. It depends. If you don't have a lot of retirement assets or something, then you probably definitely want to take advantage of that. Maybe you're not leaving the legacy that you would have liked, but you're also not stiffing your kids with a bunch of, having to pay a bunch of medical bills out of your estate.
Mm-hmm.
So that's a big one too. There's other ways you can use it. I don't want to dive too far into the weeds here because we kind of already ran way over time, but I'll just talk about a couple of things here. Like, what do people get wrong about it, and what sort of obstacles do people come across, when it comes to like, hey, I'm interested in this. I want to look at it. So some of the things people get wrong about it, probably the biggest one that I hear is the buy term and invest the rest. Complete garbage from a strategic standpoint. Like, buying term and investing the rest, because that term is going to go away one day, and there's no guarantee that you're going to um, build sufficient assets over the period of time that you have that term to make sure that you take care of everything when your estate gets settled. Not to mention that a lot of that stuff that's in the market, you're putting in a lot of risk with the market loss, right?
Mm-hmm.
There's taxation risk, there's inflation risks. There's a lot of stuff. I actually have I think you've seen it, the class that I built, like, that talks about all the different risks associated with market driven assets, right?
Yeah, we'll talk about that
Yeah.
in other episodes, right?
But buying term and investing the rest, it's cheap. You get a lot of death benefit for it, but after that term is up, you're going to pay a lot more for costs. And not only that, but that once that term's up, yeah, that's great. You have a whole bunch of other assets. Guess what's going to happen when your estate goes into probate? Your family's there's going to be a lot of taxes associated with all those assets that you're passing on to them.
Mm-hmm.
So, I personally don't like that. insurance companies love buy term and invest to rest because it's basically free money for them. You're paying them, you know, all these premiums for this term policy. What is it, like something between 1 and 2% of term policies ever pay a death benefit?
Right.
So that's like free money for them. That's one of the reasons that you're paying more for less with a permanent policy, is that they know at some time, like you said it before, you're going to die one day, right? So they absolutely love that. Like, yeah, dude, get a term policy. You just pay us, a couple thousand a year, and we'll, you know, we'll just take that for 20 years, and that's it, right?
Yeah.
Free money for us. So, the other thing too, buying off of price instead of value. A lot of people will say, well, I'm just going to buy whatever's cheapest. Like, that's not necessarily the best thing to do. It's good to have somebody who can kind of guide you along, and knows which companies have good policies and don't. And maybe somebody who isn't specifically tied to one certain company help you shop out different ones. Um, the other one is it's too expensive. That's the one I hear all the time, and I'm like, well, again, when you focus on price instead of value, you're absolutely asking to not get the best deal, to get the best bang for your buck. Um, I look at that as like, if you think that's too expensive, well, look at the whole picture. Like, are you saying it's too expensive because you're putting a ton of money into these other assets, or are you saying it's too expensive because, the great thing about these is you can design them any way you want. Maybe you don't want to pay, $1,000 a month like I am for mine for, till whenever. Maybe you say, hey, I'd rather just do $500 a month for double the amount of time. Eh, that's one that you can actually accommodate somebody on pretty easily. Especially, the good thing about these is if you start early, you don't have to put away as much in order to get the same result at a certain time period, right? Had
Mhm.
I started doing this when I was like 20 or something, when I was in awesome shape, and yeah, because you're never younger and healthier than you are now.
Mhm.
Like, dude, I probably could have put away a quarter of the amount that I am now, and still had, probably more than I would it when I'm 65, right? So eh, that's it's not too expensive. It's just your priorities are probably somewhere else, or you don't want to. It's just you don't really understand what you're getting when you're paying into this.
Mm.
And then the other one, when they say it's not a good investment, that's the one that cracks me up, because you know those people that tell you to go out and buy mutual fund, they say, hey, one of the things about these policies, you incur a lot of the costs up front, which for a long-term strategy I don't think is that bad of a thing. But it's funny, like I've heard some of these people will say, don't buy life insurance because all the costs are up front. Buy term and then go buy mutual fund A shares. Well,
Mhm.
what's the thing about mutual fund A shares? They have an upfront sales charge,
Right.
right? It's I just think it's ridiculous. It's like you just completely contradicted yourself. But
Well,
again, I'll go ahead.
I was just gonna say, well, who cares if the costs are up front if the total overall cost is cheaper? Like
Yeah.
that's when you if you're paying 1% of fees, and that's probably not the only fee you're paying. That's what they tell you. Let's just say it's 1%. It it'll be not very much now, but the person that's charging that 1% fee wants you to have the biggest bucket of money many years from now. So yeah, everybody's hoping that the account grows, but that also means that the fees are going way up because it's all just based on an average. It's not based on anything other than that.
You actually incur more costs
Yeah.
as you
When
get.
you save more
Yeah.
money.
So, but that's the other thing about it's too expensive. That's the one thing people say, um, especially with IULs. As you get older, they say it becomes too expensive. That's completely not true. If somebody's telling you that, it's because they don't understand how to use it. They don't
Mhm.
understand how to design it properly. And I used to think, what does that mean? Because I would hear people say that, And then, you know, I sat down with somebody who knows how to use it, and I was like, oh, okay, that completely makes sense. So if somebody's telling you it's too expensive, go talk to somebody who does. I will tell somebody right now, go talk to people on both ends of the spectrum. Hear all the things that the opponents of it don't like about it, and then go talk to somebody who does like it and see why that's bullshit. Right? Because that's the one thing that I kind of realized when I met you and we started talking about it. And I was like, oh, wow, dude, the people I was getting all my information from didn't understand how to use it. Right. But, you know, going back to that's not a good investment. You're paying the stuff up front. You don't have to worry about market loss. You don't have to worry about taxation on growth. And you also don't have to worry about taxation on withdrawals. So that to me is a complete garbage argument. I can go do comparisons and show people the math and say, hey, here's why this isn't a bad investment. So, and then the obstacles, right? Probably the biggest one with these is qualification, figuring out, you know, do you qualify for it? Because you know, the insurance company is kind of hedging their bet on you being able to live long enough for them to, you know, they know they're going to have to pay the death benefit eventually.
Mm-hmm.
So they want to make sure that they can delay that as long as possible. You know, probably. So, you know, if the healthier and younger you are, the better your chances are of getting the best deal, getting the best rating, which gives you the best circumstances to use this properly. And then the other one, social media. Think you and I talk about this all the time. The
Mm-hmm.
Facebook groups, all the people who, you know, well, I did this, I did that. This person told me this person told me that. Where are your facts? You know, oh, you don't believe in facts. You're just ranting, whatever. I can't stand that stuff. So if you're getting your financial advice from a Facebook group, please don't visit our website. Don't call us. Um, turn this off right now because you know, if that's what I have to overcome, I don't want to. It's not. I want people who want to learn how to use this stuff and aren't going to contradict everything that I say with something they heard in a Facebook group from somebody who has no idea what they're talking about. And then, you know, I think this is the biggest one, especially for married people. And you and I know this all too well. If you're getting into something like this, you need to include your significant other in these discussions. They need to sit down and learn about it alongside you because you don't want to go through this process of getting qualified and getting everything set up. And then at the very end, you say, hey, here's what they're telling you're telling them everything secondhand, and then at the end they just say, no, I don't like that. This Facebook group told me this. Right?
Right.
So if you don't do that, I guarantee you your chances of failure are going to go up significantly, and you're going to be stuck in the same rut you were before you came to talk to us.
Yeah. No, that's a huge point. You gotta. I mean, I think of a very good friend of mine, someone I was supporting with their business. I mean, I even flew across the country a couple times to go see him speak at a conference, and he kept on telling me, Scott, you got to get me out of this VGLI and SPP. You got to get me out of it. It's like, okay, and he was a hard person to get qualified, so did a lot of work to get him qualified, and because we were super close friends and it had been years. I mean, it took us a year before he was even able to start the qualification process, and then with COVID it took, you know, almost a year to get him qualified. And then at the end of the day, that's when oh, I just lost access to my Facebook account somehow. Anyways, but
Yeah.
we're wrapping it up. But it was just, you know, I was sad that obviously we didn't get the business, but it was more sad that we weren't able to take care of him because he was so adamant. Because when he talked to it about his with his spouse, she just was like, new information. I thought this was the plan, and I've got friends, and they're not doing that. So what is this? And anyways, it just doesn't help. It doesn't help anybody actually solve problems if we're not keeping everyone in the loop in the family. We're all the decision
Yeah.
makers. So
I've seen it before when you have a married couple and they both work together, like, and they sit in and learn about
mhm.
it together. Absolutely. Like they're both like, oh yeah, this is great. When you just have like the husband who's like, I'm going to sit in on one of these. And then they're like, yeah, I like it. I'm just going to go run it. I'm going to go check in with headquarters, right?
Mm-hmm.
They come back and they're like, yeah, my wife said no.
Okay.
And probably the chances are they were like came up to their wife while they're doing something else, like either they're working or hey, yeah, I think we should do this, and they're like, I don't, what are you
Yeah,
talking about?
that's understandable. That's totally fair. But well,
Oh,
cool.
yeah.
Well, yeah, that was a ton of info for today, and obviously we'll get into this stuff in a lot more detail in future shows and episodes. But if you want to dig into it right now, we've got this page on our website, and then more specifically, if we go back to it, actually, I'm going to show you how you can find this. If you don't go directly to the link, if you're on our website and you're looking for more info, here on the resources page, um, come down here to the military veteran life insurance stuff, and that will bring you there. But the new page we have coming up is if you want to talk to us about some of these strategies, putting your war chest together, here's a new page we have up, and you can book an absolutely free consultation call with us. And what we'll do is set up an asset map consultation where we help you take a look at your financial inventory so you know what you got, and then we can talk about some strategies, some ideas, and then if it makes sense to implement a war chest strategy for you and your family, we'll talk about those next steps. But this is absolutely complimentary. It's our way of giving back to the military and veteran community, so we'd love to chat with you about that. And you can get that right on the front page of our oh, it's not, it opened a new page, my bad. You didn't see that when I was sharing it. Hold on. All right, this is what I'm talking about. So if you're on our main page and you hit this page right there, you'll get access to um, the war chest page and access to doing a free consultation with us and doing the asset map. So this is what I was trying to show you a second ago.
There you
All
go.
right, cool. All right, cool. Well, awesome. And that's all we got for today. Have a nice weekend, and we will see everybody next time. Take care.
Later.